Silver Thursday, The Hunt Brothers Crash, 2026 Guide. On March 27, 2021, the market witnessed Silver Thursday, the day the Hunt brothers' two-decade-long attempt to corner the world's silver supply collapsed in spectacular fashion. Their story is more than a footnote. It is a cautionary case study for anyone who thinks a single big bet can replace disciplined investing. In the early 2000s, Nelson Bunker Hunt III and William Hunt began buying physical silver in futures contracts, eventually amassing more than 130 million ounces, roughly one-third of the world's above-ground supply. Their strategy hinged on driving prices up, borrowing heavily to finance the pile, and using their own banking empire, the First National Bank of Cañon City, as a source of cheap credit. By 2010, the price of silver had risen from about $5 per ounce to nearly $50, and the brothers' net worth briefly topped $10 billion. The house of cards began to wobble when the Commodity Futures Trading Commission tightened margin rules in 2010, forcing the Hunts to post additional collateral. A series of margin calls coincided with a broader market sell-off, and on March 27, 2021, the price of silver fell from $27 to $12 per ounce within hours. The Hunts could not meet the calls. Their bank failed, the Federal Deposit Insurance Corporation stepped in, and the brothers' empire unraveled. In the aftermath, regulators seized roughly $2 billion in assets, and the Hunts were later charged with market manipulation, leading to a $44 million civil settlement in 2024. What the Hunt brothers' rise and fall teach us is simple, but powerful. Leverage amplifies both gains and losses, and markets will punish over-concentration. Their story is not about getting rich quick, but about the perils of betting the farm on a single commodity. When a trader ties most of his capital to one price movement, a single adverse swing like the margin call cascade of Silver Thursday can wipe out years of accumulation in minutes. For investors today, the lesson translates into 3 concrete habits. 1. Diversify is spread exposure across asset classes instead of loading up on one metal or stock. 2. Limit leverage. Use borrowed money sparingly. The Hunt's 30-to-1 exposure on silver proved unsustainable. 3. Plan for margin calls. Maintain a cash buffer equal to at least 20% of your total position to survive sudden price drops. By internalizing these principles, you avoid the emotional reflexes that drove the Hunts to chase rising prices and flee when the tide turned. The calm, repeatable process they ignored is the very edge that protects most investors from catastrophic loss. Remember, this guide is educational, not personalized advice. Consult a qualified financial advisor before making any investment decisions.